Hey guys, this is Jacob Vanderslice with Van West Partners. You're listening to my good friend Kyle Stanley's podcast, The Fearless Investor. Keep listening to conquer the world of investing.
Hey guys, welcome into the Fearless Investor Podcast. You're listening to me, Kyle Stanley, and I am so excited today to be talking with Jacob Vanderslice from Denver, Colorado. Just a super cool, down-to-earth guy who I believe is going to resonate with a lot of you. He used to be a firefighter, and he started building up his real estate investments on the side while being in a 9-to-5 job. Well, for firefighters, not 9 to 5, but you're still putting in those 40 hours a week. And there's so much stress, mental stress, and that as well that goes along with it. So for him to be able to do this and now see what he's doing today in self-storage with over 12,000 units, meaning he has about 25 different properties, but 12,000 units combined in all those. It's really amazing to see what he and his partners have been able to do. He's going to give you a roadmap for how you can get in, or he's going to show you how you can join him in these deals. And that for me is just a great wealth of knowledge to know that you can join someone who's already doing it, or you can learn from someone who's already doing it to be able to do it yourself. So let's get right into it right now with Jacob Vanderslice to talk about self-storage. Hey guys, welcome into the show. Before we get to it with Jacob Vanderslice, I just wanted to ask you, can you actually make really good money with Airbnb? A lot of people tell me that it seems way too good to be true, but here's the deal. It is the real deal, and you can do this business without even owning a property. Yes, I said without even owning a property. It's crazy, right? But when I learned this, in under 18 months, I went from 0 Airbnbs to 25 and netting over $20,000 per month. And guess what? You can do the same. All you have to do is download our Airbnb Kickstart course. In this course, I teach you how to master, automate, and scale an Airbnb business that can pay you 6 figures almost completely passively. Wouldn't that be awesome? So go to fearlesskyle.com to learn more about this course. What are you waiting for? Download the Airbnb course right now. Start conquering Airbnb. And as we get into this with Jacob Vanderslice, first of all, Jacob, thank you for being here. You're the principal of Van West Partners. We're going to talk about a lot of different real estate today. You used to do a little bit of Airbnb, used to do a lot of bit of flipping, but now today doing self-storage, and I'm excited to talk to you about that. Thanks for being on the show.
Thanks for having us, Kyle. Appreciate it.
Awesome. So coming in from Denver, Colorado, and I know you've done real estate all over the country, but let's just zero in. What is the one story, one crazy, funny, or learned a lesson story from real estate in your years?
Well, I've got a lot of stories about real estate, but we'll do a self-storage story. Occasionally on infill storage locations, you've got some crime and theft issues, and we had a drug addict take a bunch of stolen goods into one of our units, and he also stole a U-Haul. Okay. And took the U-Haul decals off the truck and replaced the plates with fake license plates so the cops couldn't track him. So we kind of find out about this guy, and we call the police officers up and say what's going on. And 4 cop cars show up. And I guess this guy's got a rap sheet, pages long. And we're all watching out the window from the top floor of our office building, watching this whole thing go down. He's in the parking lot. And the guy starts getting a little confrontational, and all the cops draw their guns on him.
Oh my gosh.
We're thinking, this is about to get bad. And he reaches in his pocket, and we're thinking, oh, don't do that. And he takes out a meth pipe and throws it over the fence, thinking the cops aren't going to see it get thrown over. And we thought when he took that pipe out, he was going to be having a problem. Thankfully, he didn't. But we unfortunately got to watch the cops take down a criminal in our parking lot and haul him off in handcuffs. So. Not unfortunately an uncommon occurrence in infill self-storage facilities, but that's one of the more recent ones.
Oh my gosh. I have the first house I ever owned that I lived in. I had a few homeless people problems, and I showed up to my home one day and there's cops in the front yard, and there's literally, it was like straight out of Breaking Bad. It was like this little mini, like really nice, like silver suitcase, and there was needles and drugs and all that kind of stuff. And they're like, well, in case you're ever wondering, this is what happens when a homeless person tries to run away from the cops and throws it into your front yard. So
yeah, we've had homeless guys set up camp in one of our units and order a pizza. Yeah.
It always cracks me up that these homeless people have the technology to order pizza and live a regular life, but they just choose to go on.
And they've got their iPhone plugged in and storage unit, and yeah, God bless them.
To each their own. I get it. But hey, let's jump into the meat of our conversation today. And I'm excited because self-storage is something that is really, really interesting, but I want to know before we get into that, what did life look like before? I know you've been in real estate for a while. And also like why self-storage, what brought you there? Can you just share that?
Yeah, well, I'll tell you the quick backstory. I've been investing in real estate full time for about 15 years. I was a career firefighter, and you only work 10 days a month, so you've got some time on your hands. And I
Yeah.
started experimenting with residential deals on the side, and I got busy doing those, and I quit my fire job, and I've been unemployed ever since in real estate. And we scaled up our buy, fix, and sell business and accumulated some rentals over the years. And we raised some private equity and some private debt to scale up our portfolio. And since 2007 or so, we've done just over 1,200 residential deals. We've built townhomes, we've built duplexes. Mainly did all those deals in Denver, but we got in some other markets around the country. We were talking earlier before we started recording. We did a bunch of deals in the Central Valley years ago, out by
Yeah.
you. Um, so yeah, kind of came up from residential. It's a business that we know and love, but deal flow is so difficult right now to source. We
Right.
kind of paused it about 6 months ago. We weren't doing that many deals beforehand anyway. And then we got into commercial real estate as an additional line of business back in 13 and 14. And we did some of the more fun projects we've ever done. Storage is a great financial play, but it's a little bit less fun than these. So we would buy old warehouses around Denver, just
Okay.
busted 100-year-old brick structures. Some have been vacant for a long time. And we put a bunch of money into them and convert them into experience-based retail. So restaurants, breweries, yoga studios,
Oh,
coffee
cool.
shops. Did some pretty good sized deals. We sold a bunch of those off. We held on to others. Thankfully, all of our tenants but one have made it through COVID, and they're all
Oh,
kind of
that's
coming
great.
out the other side. And they've got new PPP coming, which is going to be great. Um, so yeah, then we've been studying the self storage business for a number of years leading up to our first deal, and we did our first acquisition through a programmatic joint venture with some high net worth guys and a life insurance company that we did here in Denver. So we built a few facilities in downtown Denver. We repositioned an old office building into self storage and bought a value add deal by the airport, and got to know the asset class really well, and kind of grew it from there. And we expanded into the Midwest. And so now we're in Florida, North Carolina, Iowa, Wisconsin, Illinois, more recently Ohio, soon to be Michigan. And we've got 25 facilities, just over 1.2 million square feet,
Wow.
and around 12,000 units. But it's been a good business for us, and it's been our primary line of business the last 3 or 4 years. We still
That's
dabble in some residential development, a townhome project here and there, but self-storage is mainly what we focus on.
now maybe I missed something, but did you say you don't have any units in Denver?
We do have storage units in Denver.
Okay,
Yep.
you do.
Yeah, we
All right.
have. Yeah, we have 5 facilities in Denver. Yep.
Okay. Got it.
Yep.
Got it. So really quick, because I have a lot of questions about self-storage, but I do want to ask you, you were a firefighter while you were building up real estate on the side. I feel like there's a lot of people listening right now that have that full-time job, and maybe do have that kind of flexibility like a firefighter or don't. But where did you find like the time, the motivation, the desire to want to build something after putting in long hours with a regular job as well?
Yeah, I've always wanted to be on the entrepreneurial side of things. A steady Eddie job is appealing because you get paid every 2 weeks, and there's less risk, obviously.
Hmm.
But I always wanted to run my own shop and be in the real estate business. And I had been looking at it for a long time, and I made a lot of mistakes early on. And that, in fact, pretty much everything we've done for the first time, we've made mistakes. And the best way for someone to learn how to do real estate, frankly, is to go out and do a deal.
Yeah.
Try to do the right deal, try to buy it right, but don't think too hard about it. Doesn't have to be a home run. If you lose a bit of money, you can look at that as your education in real estate. You can apply all the principles that you learned by making mistakes into your next deal. But I think just being active in the investment space and pulling the trigger is the best way to learn.
I totally agree. I look back at deals that I did in my first year that I know I wouldn't do again, but those deals made way more, or it made me way more equipped to be able to go out and do the next one. It wasn't about the money that was made. It was about the knowledge I gained. So
Yeah,
I
we
love
haven't
that.
learned anything from our home runs. We have learned so much from our mistakes.
Yeah. I,
Yeah.
I, I feel you on that one. So let's talk more now about self-storage. So you said that you've got, what did you say, over 12,000 units?
Around. Yeah.
Okay.
Yep.
how do you go from 0 to 12,000? Like let's start back at the very beginning. How do you just even get that very first one? Talk about that first deal if you even remember it.
Yeah, the first deal was a ground up development here in Denver, and we were minority partners in it. But we found a group that wanted to programmatically joint venture with us, and we found a land parcel downtown, and we underwrote it and went through the entitlement process. We found a contractor, and we built it. And the guys we did it with just wanted to do more. They don't want to do just one JV deal with a partner at one time. They want to do it programmatically and in scale. So we had some capital behind this and just kind of kept going.
That's
And
great.
just incremental. I mean, in self storage, if you say you have 12,000 units, it's not like saying you have 12,000 apartment units.
Hmm.
I mean, our average unit size is around 100 square feet. And a storage facility and a storage unit doesn't cost very much to build as opposed to multifamily. So it sounds like a big number, but relative in self storage, it's not huge. It's kind of middle of the road.
Okay. So yeah, what does that really equate to then in terms of actual like pieces of property?
So that is between 25 facilities.
Okay.
We'll be up to 30 facilities by middle of March. We're under contract on a portfolio in Michigan with 2 deals outside Detroit and 3 deals in Grand Rapids, and we've got a few more in the pipeline behind that we're close on as well.
Cool. And so when we talk about self-storage, we're talking about, someone who's just like literally the person that we're talking about that's probably renting from you is they've got all this stuff that doesn't fit in their house and they need to be able to put it into something like this and they pay you a monthly rent. Is that about right?
That's exactly right, and that's our typical customer. So I have a storage unit. We have a storage facility underneath me right now on the first floor of our office building, and I have a 10 by 20 down there. And in that storage unit, I keep family heirloom furniture that is sentimental, but I don't want it in my house, so I'll never get rid of it. I keep my mountain bikes, my skis, my golf clubs, like all my seasonal gear. And I'll probably not ever get rid of that unit. And that's the typical storage customer. People think they're going to store for a couple months and end up storing often for a couple years. And by the time you pay a few years of rent, you probably could have bought new stuff. But it's out of sight, out of mind. They don't want to deal with moving it. They don't. Maybe there's an emotional attachment to what's in the storage unit, so they pay their rent and their stuff stays.
You're kind of like a gym owner. You make your money off the people that pay but don't always show up.
Yeah, exactly. I am one of those gym customers for sure. Yeah.
That is so unique. Yeah, I've never had a self-storage unit, but I just could imagine if I had one, it's just not really top of mind because how much are they renting it for every month?
Depends on the unit size. Our prior funds average in place rent is about $93 a month.
Okay.
So not a lot, not a little.
Yeah.
And one of the revenue drivers in storage are rate increases. As you know, talking to other storage guys, they're all 30-day leases. So you can send out a rate increase notice to your customer base. Hey, your rent's going up by $5 a month. And most people are not going to move out because of that rate increase, given how inconvenient it is. They have to find somewhere to put their stuff. They have to get a buddy. They have to get a truck. So our customer base is fairly sticky. And if you can give them some amenities after you buy a new facility, like new paint, new gate system, a better online interface, you can justify those rate increases a little easier. And some people don't even care. They just pay a little bit more and they don't want to move their stuff.
Yeah. You used a word there, sticky. And I like that word because when you have a product or service where you have something sticky, where someone's coming back again and again or paying again and again, it just seems like a perfect formula. Is that part of what attracted you guys to self-storage?
Yeah, it's certainly part of it. What also attracted us, in addition to the stickiness, and I think our average duration of tenancy in our portfolio is about 9 months. So if a customer moves in, chances are they're going to be there for 9 months. We do have one guy in one of our facilities in Wisconsin who's been in his storage unit since 1987. We obviously didn't own it in 1987, but he's been there for a long time. We also like the dynamic revenue management aspect. So you can respond real time to supply and demand changes, not only within a submarket, but on a specific unit type. Okay. So for example, if you have 10 by 10s that are really full, you can incrementally increase rates on those 10 by 10s. And likewise, if you have a 5 by 5 unit type that's lighter on occupancy, you can lower rates on the 5 by 5s to drive critical mass occupancy, get it up, and then start doing rate increases. So it's the polar opposite of like a triple net industrial lease. where you know exactly what you're going to make for a 10-year lease, assuming the tenant pays their bills every month. It's very dynamic, and it's constantly changing based on market conditions, seasonality. For example, our Wisconsin portfolio, our rates go way up in the summertime, as well as our occupancy, and our rates go down quite a bit in the wintertime just because of the seasonality. But our Florida portfolio, there are peaks and troughs, but they're not nearly as extreme. So you do have a lot of changing revenue streams to forecast and frankly take advantage of when the time's right.
So what kind of management goes into this? I mean, it sounds like when you've got these seasons and especially if people aren't, staying in year after year, there's probably a lot of turnover where you're having to get those places filled.
Yeah.
Is it possible to automate the management process?
So there's certainly a misconception out there in storage that it's kind of fire and forget, no tenants, no toilets, and that's true to a degree. But overall, it's very operationally intensive. I liken storage most. It seems like a stretch, but to hospitality. And in the hotel business, you've got rates that change all the time. You've got a very important and critical customer service component, and you've got customers moving in and moving out every single day. So it's definitely operationally intensive. As far as the management goes, it depends on the facility type. There are a few groups out there who remote manage everything they have. You don't have to talk to an on-site person. You can just do it all electronically. We have kind of a hybrid depending on the facility type that we have. So if we have a smaller, traditional single-story, non-climate controlled storage facility, we don't staff that with a full-time person. We have a rover that comes that does quality control checks and unit audits and repairs and maintenance, but our customer base can move in without ever talking to a person or seeing someone in person. And on the opposite side of the spectrum, we've got big climate controlled facilities, more square footage, bigger space. And if you've got a large climate controlled facility, kind of like I described earlier in the conversation, sometimes bad stuff happens in self-storage facilities, and you don't want people coming and going into an enclosed environment when no one's there to kind of keep an eye on them. So those are staffed full time. And then in between those two, we've got deals that have kind of a hybrid climate control and non-climate control component. And by and large, we staff those full time. Sometimes we'll run a couple satellite locations out of a larger location that are not staffed, but we have someone within a mile who can come over and handle a customer issue if they need to. So kind of a hybrid.
Gotcha. You're going to hear my dogs barking in the background here. Sorry about that.
That's all right.
Hey. All right. So let's talk about this because the first thing I'm thinking of right now is comparing this to apartments. And so the thing I'm kind of thinking of right now is, like it's commercial and we always are talking, it seems like in real estate, there's the mindset of either like wholesaling or there's single family homes for rental or for flipping. And then there's commercial for long-term holds, but that's usually equated to apartments. So like, why go into this rather than apartments, I guess is my question.
So I love residential as an asset class. I think workforce housing is very defensible right now. And I think our nation, just given how home prices have appreciated, is shifting more so to a nation of renters than it is a nation of homeowners. And I think it's a great space to be in. The challenge with multifamily right now, that at least that we've seen, is yield. And that's current yield. That's not all in upside on the deal. I mean, if you build to a 6.5 cap and sell at a 5 cap, that's a good return. But we're very yield focused investors. We like current cash flow. And we target facilities in general that can pay at least an 8 to 10% cash on cash return per year. So that's an important aspect to us. And we just weren't finding that in multifamily. As far as it relates to, kind of separating out the two asset classes, they're similar in that you're dealing with people. It's real estate. You've got the tax advantages to it. But multifamily, you typically sign a 1-year lease and you've got some unit turnover and some fair housing issues to deal with. But once somebody signs a lease, assuming they pay, you're not doing a whole lot other than R&M and accounting. And self-storage, because they're 30-day leases, notwithstanding our customers who stay much longer than that, you constantly have this turnover. And that's what makes it a little more operationally intensive than multifamily.
Okay, I got it. So then for you, it sounds like even though there was more operational, it was really more of the cash on cash returns.
Yeah,
Okay.
the dividend yield we found was superior to multifamily for
Okay.
sure.
Awesome.
Yeah.
So if I'm sitting here and listening to this episode right now, and I'm hearing everything you're saying, I'm probably thinking to myself, do I want to get in? And I guess my question then to you would be, how would someone getting into self storage? What would be the first step they should take?
Yeah, well, the first step is to buy a deal, right? Like we mentioned in single family earlier, the best way to learn the business is to buy a deal. You can read books, you can get educated, but you're not going to learn as much unless you're actually out there operating it. If you're going to buy a storage facility, one of the first things you should consider are the supply ratios in the submarket. So self storage is very local supply sensitive. And we track supply ratios in the 1, 3, and 5 mile trade radius when we make an acquisition decision. And nationally, self storage is around 7 square feet per capita. And once you get over 8 or 9, you start to see a decline in occupancy and rates. And then once you're under 7, maybe down to 5 or less, you start to see an increase in occupancy and rates. So if you're going to look at a storage deal, make sure you understand the supply ratio of the submarket. And on the revenue side, make sure you understand the seasonality of the submarket. So if you're underwriting an acquisition and you're only looking at July rents, for example, and you're assuming those July rents are going to stay the same throughout the entire year, you're probably wrong, because they're going to go down when it's cold out, or whenever something might happen depending on the climate. And so understanding the revenue stream and how the peaks and troughs work is important. Um, Operationally, um, typically, if you're buying a small facility, it's going to be hard to justify paying for a full-time on-site manager. And once you're north of about 40 or 50,000 square feet in net rentable square footage, you can probably justify paying someone to be there and not have it be too big of a piece of your bottom line. But if you're buying under that, maybe around 30,000 square feet, you're just not producing enough revenue to find a full-time staff member. So you have to be prepared to have someone go over there to do unit checks and quality control checks. You could certainly outsource the management to a third party. There's a lot of operators out there that do third party management, but you're going to pay a fee for that. Typically it's 5% of gross rents, maybe 6, but you don't have to deal with it yourself. So definitely things
Yeah.
to consider, but you could also find yourself being a very active owner operator if things aren't going well.
Yeah, that's very similar to, landlords or Airbnb hosts. We can
Yep.
either do it ourselves and take calls at 11 p.m. at night and save a bunch of money, or we can outsource it in-house and teach someone how to do it and save some money, or we can go to a professional company and have them do it for us. So
Yeah. Just
there's a
depends on
lot.
your ROI and your time and
Yeah.
your investment strategy,
Yeah.
for
Whatever
sure.
the end goal is, you got to
Yep.
match that. So, um, question before we really wrap up here. I'm trying to envision, like, what does a deal look like? Is it just a piece of land and we're going to have to build it from ground up? Is it a warehouse that we're able to reconstruct as a self-storage unit, or is the best deal just taking over an already ready to go self-storage unit? What would you say is the ideal deal?
We've done all the above, and it depends on your investment criteria. If you want cash flow out of the gates, repositioning a warehouse into storage probably doesn't make sense, and ground up development certainly does not make sense because there's no income. In fact, it's a negative yield until you get cash flow in place. Most of the deals that we've been buying the last 2.5 years have been existing facilities, and there's a lot of value creation just by implementing more operational management efficiencies. So we'll do some nominal capital improvements like new gate systems, new doors, new seal coat in the asphalt, but the majority of our value creation on each deal is getting below market customer rents up to market and controlling our expense load and growing occupancy over time. So if you're going to do your first deal, I would definitely focus on an existing facility that maybe doesn't look very good. Maybe they don't have a website. There's no way to lease a unit online. It's a mom and pop operated. Typically, when you find something like that, there's meat on the bone to create value with new management.
And I gotta imagine, because this is not like, a piece of real estate necessarily that we're looking to flip as a single family home. So there's probably not as much public information on that. So is it just driving around and trying to locate these places with your eyes?
Yeah, I mean there are public records out there. It's not as clean as single family home public records, and what you're not going to see, there's not an MLS where you can draw a box and find out what the ARV is on a storage facility, because
Right.
the sale price of a storage facility is entirely driven off of the multiple of the income stream that it produces, which is It's the same in all commercial real estate and multifamily. So there's a lot of places to look. CoStar is one of those places. It's kind of the commercial MLS. It's very expensive, but they've got access to all the data you could need. We also use Yardi. That's another data source. And one of my partners is a software engineer by training, and he built some software that's kind of like the self-storage rate MLS. So it scrapes all the top operators' websites every day. And we could, for example, draw a box around a given submarket and find out what 10 by 10 climate controlled units are leasing for, and kind of make a revenue management decision or an acquisition decision based on that data set. And the software also tracks all the historic rates as well. So we have millions of data points for the last 4.5 years of seasonal self-storage rates in given markets. Like, for example, in Florida, if you track rates right after a hurricane comes through, you can see a massive spike for about 6 months, and it kind of tails back off, back down to market. And again, the same thing with the seasonal markets like the Midwest. You can see the peaks and troughs in the winter and summertime. So there's a lot of tools out there that are available to kind of help you get a handle on it, but it's not as easy as figuring out, the ARV on a single family home using the MLS. There's a lot of levers you have to kind of understand how to pull to get there.
Yeah. Well, at the end of the day, like you said, people are going to either go out there, learn and do a deal, or another option is, you are bringing people into your deals. You want to talk about that for a second?
Yeah, we've historically done single asset syndications and self-storage. We launched a fund in 2019 that we closed in 2020. And we launched a new fund that just came out in December of 2020. We did our first round of acquisitions for that fund about 3 weeks ago, a 2-property portfolio in Ohio and Florida. And the total fund size is going to be about $100 million. We're raising between 30 or 40 in equity, and the balance of that's going to be debt. And we're just focused on buying existing storage facilities with good in-place cash flow that we can pay investors distributions through out of the gates. And there's a value creation component too. We're going to grow NOI, grow value, sell them for a profit down the road, but it's primarily for the first 3 to 5 years focused on income.
Awesome. I love it. All right. Well, Jacob, if someone's interested in getting in contact with you, how can they do that?
You can email me at jacob@vanwestpartners.com, or go to our website, which is also vanwestpartners.com, or hit me on LinkedIn.
Perfect. Any last words before we log off here?
Great talking to you today, Kyle. Thanks for your time.
Awesome. Hey, Jacob, thanks so much for being on the show and helping our audience to conquer the world of investing. All right, show notes for this one. Don't worry, I'm not going to make you spell out Jacob's name. It's going to be fearlesskyle.com/Van West, VANWEST. And I think the number one thing that I take away from this, and what I love that he preached, was do the deal and learn that way. And even if you lose money, there's your education. Like, to me, that is so solid in regards to the types of information that you want to get from high level individuals. We can spend, and it's sad, I know people who've spent $30, $40, $50,000 on education, and all they ever do is crack open a book or read or listen to a course. And because they never get into action, they never get anything done. And my thought is, well, what if you would have went and just tried to do a deal and just went blind and try to do that yourself? You probably at worst would have lost like $20,000. So you would have saved money. You would have understood the process. You would have been able to learn from it the next time. And I love that advice. So I'm not going to go too far into that, but I hope you take that away just like I did. Anyway, I hope you will go check out the show notes on this one, against fearlesskyle.com/Van West. And thanks again for joining us here on the Fearless Investor Podcast. We're helping you to conquer the world of investing. See you next time.